Gold is sitting at $4,800 per ounce as you watch this video. That is not a typo. That is not a prediction. That is the live price of gold on Friday, April 17, 2026. And while most people are watching that number and asking whether they should buy, the people who already understood what was coming bought years ago, and they are not watching the price the way you are. They are watching something else entirely. They are watching the door. Because the specific group of people we are going to talk about in this video, the billionaires, the hedge fund managers, the central bank governors, the institutional allocators who move hundreds of billions of dollars at a time, they have been doing something in the last 18 months that does not match the public story they have been telling in their investor letters and their television appearances and their conference keynotes. They have been moving everything to physical gold, not gold ETFs, not gold futures, not gold mining stocks, physical gold, bars, coins, metal in a vault with their name on it. And the specific reason they are choosing physical over every other form of gold exposure is the most important financial story of this entire decade, and the financial media is almost entirely failing to explain it. By the end of this video, you are going to understand exactly what the billionaires know that they are not saying publicly, why physical gold specifically is the vehicle they are choosing, and what the difference is between owning paper gold and owning the metal itself, what the three simultaneous crises are that have all converged in April 2026 to make the liquidation from paper assets into hard metal the most rational financial move available to people with serious money, and what this specific behavior from the people who are closest to the system tells you about where the system is actually headed. This is not a video about whether gold is a good investment. Gold has already proved that. It went from $1,250 per ounce in 2016 to $4,800 today. It gained 64% in 2025 alone. The highest it ever traded was $5,589 per ounce on January 28, 2026. The question this video answers is not whether gold works. The question is why the people who move markets are choosing to hold it in physical form right now, in this specific moment, and why that specific choice reveals something about the financial system that most people are not yet prepared to understand. Let us start with the specific behavior and the specific names, because the abstract claim that smart money is buying gold means nothing without the concrete evidence of who is doing what. Paul Tudor Jones is one of the most respected macro traders in the history of financial markets. He has been running Tudor Investment Corporation for 46 years. He manages over $83 billion in assets. Tudor Jones is not a permabull on any asset class. He is known for getting out before everyone else sees the exit. His most recent SEC filing showed something that the investment media reported as a footnote but deserves to be the headline. Tudor Jones sold down significant positions in Apple and Alphabet, while simultaneously increasing his position in the SPDR Gold Trust by 49%, nearly half again as much exposure to gold, funded by reducing his holdings in two of the most dominant technology companies on Earth. That is not a tactical hedge. That is a strategic repositioning. That is a man who has spent 4.5 decades reading financial markets, telling you something about the relative value of paper assets versus gold without using the words. Ray Dalio is the founder of Bridgewater Associates, the world's largest hedge fund by assets under management at approximately $150 billion. Dalio has spent decades studying economic history and monetary cycles going back 500 years. He is not given to dramatic public statements. When he makes one, the institutional world listens. In January 2026 at the World Economic Forum in Davos, and then again in February 2026 at the World Governments Summit in Dubai, Dalio made one of the most direct statements of his career. He said the monetary order is breaking down. He called gold the safest money in the world. He described the environment as a capital war, a period in which nations are deploying currencies, reserve assets, and capital flows as geopolitical weapons rather than neutral tools of commerce. And then he gave specific guidance that is almost unprecedented in its clarity. He told investors they should hold between 5 and 15% of their entire portfolios in gold. Not because gold is going to go up, because the alternative might go down in ways that paper assets cannot protect against. Goldman Sachs, in their most recent updated gold outlook from April 2026, raised their year-end gold price target to $5,400 per ounce. JP Morgan's research team has a target of $6,300 per ounce. Bank of America, HSBC, and Societe Generale are all at $5,000. Yardeni Research has a $6,000 target. And then there is the most extraordinary market development that nobody is talking about at the volume it deserves. On the COMEX, which is the primary futures exchange where gold contracts are traded, a single institutional position appeared in recent months, targeting $20,000 per ounce on gold options, expiring December 2026. The estimated cost of building that position was $3.3 million. The potential payout, if gold reached $20,000 per ounce, was approximately $5.5 billion. That is a 1,667 times return on capital at risk. The person or institution who placed that trade either has information the rest of the market does not have, or they have a framework for understanding the monetary system that leads them to a conclusion that the mainstream financial media treats as extreme, but that the structure of that trade suggests is being taken with serious institutional conviction. Now, here's the question that the specific behavior of these specific people demands we answer. Why physical gold specifically? Because every single one of these investors could express their gold thesis through an ETF. The SPDR Gold Trust alone has $146 billion under management and is fully backed by physical gold reserves. Buying the ETF is easier. It costs a fraction of a percent per year in expenses. It can be bought and sold with a click. Why are high net worth individuals and institutional investors, as documented explicitly in Goldman Sachs' most recent research, increasing their allocations specifically to physical gold bars rather than to the ETF? The answer to that question is the core of this video, and it requires us to understand the specific risk that paper gold does not protect against. Let us start with what happened in 1971 and why it is the most important financial event of the last 100 years. Before August 15, 1971, the United States dollar was backed by gold. Every dollar in circulation was theoretically convertible into physical gold at a fixed rate of $35 per ounce. Foreign governments and central banks could present their dollar reserves to the United States Treasury and receive actual metal in exchange. This mechanism, established at the Bretton Woods Conference in 1944, was the foundation of post-World War II international monetary order. It meant that the amount of money the United States could create was limited by the amount of gold it held. Then Nixon ended it. He called it a temporary measure. It is now 55 years old. When the gold standard was abandoned, the amount of money the government could print became limited by nothing except its own willingness to print it. The Federal Reserve's monetary base, which is the bedrock measure of money creation, went from approximately $850 billion in 2008 to $4.2 trillion by early 2022. That is a 494% expansion in less than 14 years, not because the economy grew 494%, not because productivity increased 494%, because the government had the ability to create money, and it used that ability aggressively. And when you create more of something without creating more of the thing that something is supposed to buy, the price of everything else goes up. This is not a theory. This is arithmetic. Here's the historical pattern that Dalio has been studying, and that explains the behavior we are seeing right now in 2026. And here is how it has played out with almost mechanical consistency across every major economy over the last 5 centuries. The cycle begins with a government or empire that has real economic strength and builds up debt during that strength because cheap debt seems like a reasonable way to accelerate growth. The debt grows faster than the economy. Then it grows much faster. The cost of servicing the debt starts to consume a larger and larger fraction of government revenue. At that point, the government faces 3 possible choices. Choice 1 is to raise taxes and cut spending to pay down the debt honestly. This is politically almost impossible because the population that has grown accustomed to the spending will revolt. Choice 2 is to default. Actually admit that the debt cannot be paid and restructure it. This destroys the country's credibility in international financial markets for a generation. Choice 3, and this is the one that every major government with monetary sovereignty has chosen throughout history according to Dalio's 500 years of research, is to print money. Create more of the currency to service the debt denominated in that currency. Debase the money, inflate your way out of the obligation. And the holders of that currency, the people who saved their wages in dollars or euros or pounds or whatever the paper money was called, discover that their savings have silently been transferred to the government through inflation without a vote or a law or even an announcement. The United States government currently carries approximately $39 trillion in national debt as of April 2026. That number is not the scary part. The scary part, as Federal Reserve Chair Jerome Powell acknowledged explicitly in recent congressional testimony, is the rate at which it is growing. The debt is growing faster than the economy. And with 10-year Treasury yields in dangerous territory, the cost of servicing that debt is accelerating in ways that create what economists call a debt death spiral. Deficits require more borrowing. More borrowing means more supply of Treasury bonds. More supply means yields have to rise to attract buyers. Higher yields mean higher debt service costs. Higher debt service costs mean bigger deficits. The loop closes and it tightens. This is not a theory about what might happen in 20 years. This is the description of a process that is already in motion in April 2026. Now here is why this specific dynamic produces the specific behavior we see from billionaires moving into physical gold right now. When governments debase their currencies, every paper asset eventually reprices in terms of real purchasing power. Stocks lose value in real terms because the companies they represent earn revenues in the debased currency. Bonds lose value directly because the fixed payments they promise are worth less in purchasing power terms. Cash loses value fastest of all because it earns nothing while the purchasing power erodes underneath it. The one asset that has consistently held its purchasing power through every currency debasement in the historical record, going back thousands of years, is gold. Because you cannot print gold. Because no government can create more of it through policy decisions. Because its supply grows at approximately 1 to 2% per year through mining, which is slower than population growth and far slower than the growth rate of paper money. Gold is the one asset in the financial system that is not somebody else's liability. That phrase belongs to Ray Dalio, and it is the most important 4 words in this entire conversation. Every stock is a claim on a company's future earnings. Every bond is a claim on a borrower's willingness and ability to repay. Every dollar in your bank account is a claim on the bank's solvency and the government's stability. Physical gold is not a claim on anyone. It is the thing itself. It exists. It cannot be inflated away. It cannot be defaulted on. It cannot have its value destroyed by a policy decision made at midnight in a government committee meeting. This brings us to the 3 simultaneous crises that have converged in April 2026 to make the specific move to physical gold that billionaires are executing right now not just rational, but arguably the only rational response available to people who understand what is happening. Crisis 1 is the debt and monetary system crisis we have already described. $39 trillion in U.S. national debt growing faster than the economy. Federal Reserve monetary base expanded by nearly 500% since 2008. 10-year Treasury yields in dangerous territory. The specific conditions that historically precede a currency debasement event are all present simultaneously in the United States economy right now. And the IMF, in recent commentary specifically about the U.S. fiscal situation, used language it almost never uses about the world's reserve currency issuer. The IMF said America's national debt is actually a global problem, not an American problem. A global problem. Because the dollar is the reserve currency of the world economy. When the dollar is debased, every country that holds dollars in its reserves, every pension fund that holds dollar-denominated bonds, every institution that has built its financial model around the assumption of dollar stability experiences the loss simultaneously. The IMF's executive director, Fatih Birol, added in recent commentary that restoring the disrupted oil and gas output from the Middle East conflict alone could take up to 2 years. That means inflationary pressure from energy costs is not a 2-week phenomenon. It is baked into the economic forecasts for the next 24 months minimum. Crisis 2 is the geopolitical crisis and what it is doing to the dollar's position as the world's reserve currency. The Strait of Hormuz remains effectively closed under a dual blockade as of today, April 17, 2026. 20 million barrels of oil a day that used to flow through that strait are not flowing. Foreign governments and central banks who need to buy oil need dollars to buy oil because oil is priced in dollars. And where do foreign governments get dollars when they need them fast? They sell their dollar-denominated assets. Their U.S. Treasury bonds, their U.S. stocks, their dollar reserves. That process is already happening. Foreign central bank holdings of U.S. Treasuries at the New York Fed fell to their lowest level since 2012 in just a few weeks of the current conflict. The specific American institutions that were supposed to be the safest assets in the world are being sold by the same governments that are supposed to be their most reliable buyers. And every time a foreign central bank sells a Treasury bond, the yield on that bond goes up. And higher yields mean the United States government has to pay more to service its $39 trillion of debt. The feedback loop between the Middle East conflict, the dollar's reserve currency status, and the U.S. debt crisis is not a coincidence. It is a connected system failing in multiple places at the same time. Dalio described this exact scenario at the World Governments Summit in Dubai in early 2026. He used the phrase capital war specifically. He meant that in the current geopolitical environment, nations are using their reserve asset decisions, their currency interventions, and their capital flow restrictions as weapons against each other. In that environment, gold occupies a unique position. Gold has no nationality. It is not subject to sanctions. It cannot be frozen by an executive order or a Treasury Department action. When Russia's dollar reserves were frozen by Western sanctions in 2022, it was a demonstration to every government on Earth that their dollar holdings could be confiscated by policy decision. The specific response to that demonstration, documented by the World Gold Council, was that central banks bought 863.3 tons of gold in 2025. That is almost double the pre-2022 annual average. 95% of central bank survey respondents say they expect global gold reserves to continue rising over the next 12 months. China, specifically, has been accumulating gold for 15 consecutive months through January 2026. These are not retail investors reacting to headlines. These are sovereign governments making multi-decade strategic decisions about what constitutes real money. Crisis 3 is the crisis of financial system trust, and this is the specific reason that high net worth individuals are choosing physical gold bars over paper gold. And it is the most important distinction in this entire video. When you own a gold ETF, you own a claim on gold. The ETF holds the physical metal in a vault somewhere, in theory. But the claim has counterparty risk. The ETF could be suspended. The custodian bank could face insolvency. In extreme financial stress scenarios, governments have in the past restricted the ability to redeem financial claims on gold. And the most important example of this in American history is one that most people who talk about gold never mention because it sounds too extreme to be real. In 1933, President Franklin Roosevelt signed Executive Order 6102. This order made it illegal for private citizens in the United States to own gold coins, gold bullion, or gold certificates. Citizens were required by law to turn their gold into the Federal Reserve in exchange for paper dollars at a price the government set. It was confiscation, legal confiscation executed by executive order during a crisis. The government decided it needed gold and it took it from its own citizens. Now, could that happen again in 2026? That is a different question. But the billionaires who are moving into physical gold right now are not operating under the assumption that because something has not happened recently, it cannot happen again. They are operating under the assumption that during a sufficiently severe financial crisis, paper claims on assets are less reliable than the assets themselves. This is the specific logic behind the preference for physical bars in private vaults over the SPDR Gold Trust that has $146 billion under management. The ETF is useful for trading exposure to gold prices. Physical metal in your possession or in a segregated account where you own specific serial numbered bars is a different thing entirely. Goldman Sachs' own research, in their April 2026 Gold Outlook, noted explicitly that high net worth individuals are increasing allocations to physical gold bars, specifically as a hedge against what they described as regime shifts in monetary and fiscal policy. The word regime is important. A regime shift is not a recession. It is not a market correction. A regime shift is a fundamental change in how the rules of the financial system operate. When Goldman Sachs is using the phrase regime shift to describe what high net worth physical gold buyers are worried about, you're no longer in the territory of normal investment diversification. You are in the territory of people who manage enormous amounts of capital, preparing for a scenario where the rules change. Now let us talk about silver, because the story of silver in 2026 is inseparable from the story of physical gold, and the relationship between the two metals tells you something important about what is happening in industrial commodities markets simultaneously with what is happening in monetary metals markets. Silver is trading at $78.65 per troy ounce as of this morning, April 17, 2026. 1 year ago, silver was trading at roughly $32 per ounce. Silver has increased more than 140% in a single year. Fortune magazine noted this week that silver's price has improved more than 150% over the past year, reaching decade-high levels. The Silver Institute and Metals Focus have confirmed that the silver market is now in its sixth consecutive year of structural deficit. 762 million troy ounces have been drawn from above-ground silver stockpiles since 2021. The market has been consuming more silver than it produces for 6 consecutive years, and the deficit is not narrowing. Industrial demand for silver, driven by solar panels, electronics, and healthcare devices, is not declining. The above-ground supply that has been cushioning the deficit is not unlimited. When that cushion runs out, the silver market will face a supply crisis that has nothing to do with investment demand or monetary value and everything to do with basic physics. There is not enough silver being produced to meet both industrial consumption and investment demand simultaneously. The gold-to-silver ratio, which is the number of ounces of silver it takes to buy 1 ounce of gold, currently stands at approximately 61. That means silver is historically cheap relative to gold even at $78. The historical average gold-to-silver ratio over the last century is approximately 50 to 1. When the ratio compresses back toward historical norms from its current level, the person who owns physical silver, in addition to physical gold, participates in both the monetary metals move and the normalization of the ratio. This is why the billionaire movement into hard assets is not limited to gold alone. But the monetary argument, the reserve asset argument, the currency debasement argument, the geopolitical argument, all of those run more directly through gold than through silver, which is why gold is the primary vehicle in the specific liquidation we are describing. Now let us be precise about what this liquidation actually looks like at the billionaire level, because the word liquidation implies selling, and what is being sold is as important as what is being bought. Paul Tudor Jones sold Apple and Alphabet. Those are not speculative small-cap stocks. Those were the two of the most profitable and most widely held technology companies in the world. They represent the specific thesis of the last 20 years of financial market performance, which is that technology companies with strong earnings growth and global scale are the best long-term wealth creation vehicles available. Tudor Jones did not sell Apple and Alphabet because he thinks they are bad companies. He sold them because in the specific scenario he is preparing for, their earnings are denominated in dollars. The dollars those earnings are denominated in may be worth significantly less when measured in purchasing power terms. Physical gold is not denominated in anything. It is the measuring stick itself. The options trade targeting $20,000 gold by December 2026 is the most extreme expression of the specific conviction we are analyzing. To understand why that trade is not crazy, you have to understand what $20,000 gold would mean. If gold reached $20,000 per ounce from its current price of approximately $4,800, it would have increased by roughly 317% from current levels. That seems extreme until you do the following calculation. The Federal Reserve created money so aggressively between 2008 and 2022 that the monetary base expanded 494%. Gold has not yet fully repriced to reflect that monetary expansion. If gold were simply catching up to the amount of money that has already been created, $20,000 gold is not an extreme prediction. It is a mathematical conclusion. The person who built that position is not making a speculative bet on gold going up for unknowable reasons. They are making a bet that gold is repricing to reflect a monetary reality that already exists. Here's the pattern throughout history that validates this logic, and that Dalio has documented across 5 centuries of monetary history. The pattern runs as follows. Step 1 is expanding debt. Governments borrow heavily during periods of strength, creating obligations that seem manageable when the economy is growing. Step 2 is the debt trap. Growth slows, but debt service costs keep rising. The ratio of debt to income becomes unsustainable. Step 3 is monetary expansion. The central bank creates money to service the debt and prevent default, gradually debasing the currency. Step 4 is inflation. The expanded money supply meets a world of finite goods and services, and prices rise. Savers in paper currency suffer losses in purchasing power while holders of real assets are protected. Step 5 is the repricing of real assets, including gold, to reflect the new monetary reality. This sequence has played out in the Roman Empire, in Weimar Germany, in Zimbabwe, in Venezuela, in every historical episode of sovereign debt crisis where the government chose to debase rather than default. And in every single one of those episodes, the people who had converted their paper savings into physical gold before the repricing preserved their purchasing power, while the people who stayed in paper assets experienced losses that, in extreme cases, were total. The specific moment we are in on April 17, 2026, is Step 3 transitioning into Step 4. The monetary expansion has already happened. The debt trap has already closed. The inflation has been running above target for years. The repricing of gold, which was already 64% in 2025, is continuing into 2026, with the metal currently trading at $4,800, and with every major financial institution projecting further gains. The billionaires who moved into physical gold in 2024 and early 2025 bought at prices between $2,300 and $3,500. They are sitting on gains of between 30 and 100% depending on when they bought. And they are not selling, because the scenario they bought for has not resolved. The debt has not been reduced. The monetary base has not been shrunk. The geopolitical crises have not been settled. The conditions that drove them into physical gold in the first place are more present today than when they made the purchase. Now, let us talk about what this means for the average person watching this video, because the billionaire behavior is informative, but it is not directly applicable to everyone. The specific decision that people with $10 million or more in liquid assets are making is to move meaningfully into physical gold in private vaults. The specific decision that people with smaller portfolios face is a different version of the same underlying question. How much of your savings is vulnerable to the specific risks that physical gold protects against? And how much of your portfolio is in paper assets that are exposed to exactly the scenarios that the billionaires are preparing for? Ray Dalio has given the most specific public guidance on this question that a person in his position has ever given. 5 to 15% of your total portfolio in gold. His reasoning is not that gold will outperform stocks in every environment. His reasoning is that in the specific environments where stocks and bonds and cash fail simultaneously, which are the environments driven by monetary debasement and fiscal crisis, gold performs when nothing else does. The 5 to 15% allocation is not about maximizing returns. It is about ensuring that if the scenario the billionaires are preparing for actually materializes, you have something that holds its value, while everything denominated in paper dollars reprices downward. The most practical question for anyone processing this information is the physical versus paper distinction. Here it is in its simplest form. A gold ETF gives you exposure to gold prices. If gold goes up, your ETF goes up. If you want to sell, you sell and receive dollars. The ETF works perfectly in normal financial conditions. Physical gold gives you the metal itself. It does not depend on the solvency of a custodian. It does not depend on the operational continuity of a fund management company. It does not depend on the settlement infrastructure of the financial system continuing to function. In a scenario severe enough to trigger a monetary regime shift of the kind Dalio and others are warning about, the question of whether your financial claims can be redeemed is not a theoretical question. It is the practical question. Physical gold answers it before you have to ask it. And here is the specific historical fact that closes this analysis. In 1933, when Roosevelt issued the executive order that made private gold ownership illegal, he did it because the gold standard was creating a crisis. The government needed gold to reflate the economy, and private citizens were hoarding it. He solved his problem by making hoarding illegal and confiscating the metal at a below-market price. The people who had their gold in banks received paper dollars at a government-set rate. The people who had converted their gold into paper assets before the crisis received paper assets that immediately lost purchasing power as the dollar was devalued. The people who kept gold outside the banking system in private holdings that were harder to track and reach were in a position that paper asset holders were not. Whether that specific scenario repeats in 2026 or 2030 or ever is not the question this video is answering. The question is why the people who are closest to the financial system and who understand its vulnerabilities most clearly are choosing to hold physical gold right now, today, at $4,800 per ounce on Friday, April 17, 2026. And the answer is that they are not buying gold because they think they know the future. They are buying gold because they have studied the past. And the past says that when the debt cycle runs the way it is currently running, when the monetary base has been expanded the way it has been expanded, when the geopolitical order is fracturing the way it is currently fracturing, the people who are holding the measuring stick rather than the thing being measured are the people who come through intact. Gold is at $4,800 today. Silver is at $78.65 today. The all-time high was $5,589 on January 28th. Goldman Sachs says $5,400 by year end. JP Morgan says $6,300. Someone on the COMEX built a position targeting $20,000 by December with a potential $5.5 billion payout. The World Gold Council says 95% of central banks expect to keep buying. China has been buying for 15 consecutive months. Paul Tudor Jones sold Apple and Alphabet to buy more. Ray Dalio said the monetary order is breaking down. The IMF said America's debt is a global problem. The people who run the largest pools of capital on Earth are not watching the gold price and wondering whether to buy. They already bought. They are watching something else now. They are watching the door. And the specific thing about watching the door is that when the people closest to it start moving, the people farther back rarely have enough time to get through before it closes. The billionaires are not telling you this on television. They are not publishing it in their quarterly letters. They are executing it in physical vaults and private custodians and direct metal purchases that only show up in SEC filings and commodity flow data and World Gold Council reports if you know where to look. This video is where to look. The insider liquidation is happening. It is happening in public. And the specific asset they are liquidating paper wealth into is the only asset in the history of human civilization that has survived every currency collapse, every sovereign default, every monetary regime change, and every debasement cycle without becoming worthless. $4,800 today. And the people who understand what that number actually represents are not selling.